Hi there, everyone. My name's Jason. I almost forgot my mic there for a second. Welcome to Wealth Wednesday. Hope you're having a great day. My name is Jason Krausert, and today we're going to talk about something that's important to a lot of people and will likely become more important in the next year or so, particularly probably across North America, but I know in Canada, the government is talking about, or the Bank of Canada is talking about increasing interest rates. So we're going to talk today about a few ways to lower the interest rate on your high interest debts to try to save you some money. That's a good idea, whether interest rates rise or not, but in a higher interest rate environment, it's always worth looking at. So if you can just bear with me for a moment, what I'm going to do is I'm going to just share this with a couple other groups that I'm involved with that I have here on Facebook, and we can invite a few more people onto the call. Interest rates, it's an important consideration because obviously interest rates range from can range anywhere from 3 or 4% if you're looking at a mortgage or a secured debt, up to 20-25%. Anything like if you're looking at credit cards and whatnot. So it is an important consideration and can save you a lot of money if you are, if you can reduce those interest rates, a shorten amount of time that you're paying interest rates, it'll make a big difference for you. So sorry, almost here. So one more to do here. It'll be about 5 more seconds. Boom and boom. And we're good. Awesome. So thanks for your patience. So my name is Jason Krausert. I am a debt counselor and financial wellness coach. I'm founder of More Life From Your Money. And I work, one of my goals is to work with clients to help set up a solid plan for reducing or eliminating debt and building up savings so that they can take some of the stress and whatnot out of their financial lives. I've worked with close to 2,000 clients and helped them pay off hundreds of thousands in debt. That's what I'm up to. I work with clients who are also 10 to 15 years from retirement, looking for a solid strategy for how to pay off their debt and build up their savings before retirement so they can have the retirement that they want. And so I help them build that solid cash flow strategy so they can live that dream as well. So I'll post a link a little bit later about about how to contact me if that's something that interests you. So the topic of interest rates is important, like I said. On every debt, there's some sort of interest rate attached to it, and can obviously be a big part of the total cost of repaying that debt. So one of the considerations for why interest rates is important, obviously, is that when you have a higher interest debt, what it tends to do, obviously that affects your minimum payment. So high interest debt can leave you locked into a minimum payment cycle where all you're doing is you're paying minimums on the debt. And as a result, it takes longer to pay it off. And obviously it's going to cost you more over that time. So lowering your interest rate or paying the debt faster can reduce your interest rates. We'll talk about that in a minute, some more in a minute. So when you lower your interest rates, like I said, you can either lower your minimum payments so that your interest rates come down, so your minimum payments come down, which may make them more manageable and free up money for other areas of your budget. Or if your interest rate or your minimum payments are lower, you can pay more than the minimum, and that means when you have a lower interest rate, that more of that payment is going towards your principal, which can help pay the debt down faster and save you money. So the level of interest rates is really important. Now, what affects interest rates? There's kind of 2 categories of impacts, things that affect interest rates. One is what you cannot control. One is what you can control. So things that you cannot control are things like the Bank of Canada's overnight rate. These are the rates that the Bank of Canada sets to give direction to the major banks in their lending policies and in their lending interest rates in order to impact the direction of the economy. Can't do anything about that. That's a big picture macroeconomic type stuff that unless you're the Bank of Canada governor or the CEO of a major bank, you don't have a lot of influence on that. There's also supply and demand. Lending is a business activity, and like any other business activity in a market economy, prices, interest rates, or the price of a loan are impacted by supply and demand. So as more people seem to be demanding money from banks in terms of loans, interest rates tend to rise. As fewer people tend to be asking for loans and applying for loans, interest rates fall. So again, that's something that's outside of our control. We can't control when other people are borrowing and asking for money, so we can't really do too much about that. So those are a couple of things that are outside of our control. Now, what is inside your control? These are what I call the 5 C's of credit. Okay, so what's in your control is, relatively speaking, is the amount of risk that you present to a potential creditor. Okay, so just as a little bit of background, whenever you go into a bank to apply for a loan, the interest rate that you're offered reflects to a large degree on the amount of risk that the bank sees in your application. So if you have a higher risk application or a higher risk lending product, your interest rates tend to be higher. If you have a lower risk application or a lower risk lending product, your interest rates tend to be lower. So the amount of risk that you present does affect your interest rates. And that's something that you have relative to the other impacts on interest rates. That's something that you have some control over. So I'm just going to go over those really quickly. So the 5 C's of credit. Okay. Number 1, capital. This refers to your net worth. Banks like to see that you have a higher net worth or a positive net worth. So net worth is just your assets. You take your liabilities, subtract that from your assets, and banks like to see that you have a positive number. Hi, Daryl. So that's capital. Capacity. Capacity is basically your income. They measure your income against your other debt and household obligations, and they create what's called a debt income ratio, and they like to see that that ratio falls within certain guidelines. And basically, if you're applying for housing, like a mortgage, that guideline would be that they like to see your housing costs be less than 30% of your gross income, your before tax income. They also like to see that for any debt application, that your total debt obligations are less than 40% of your gross income. Collateral. Banks don't always take collateral in order to secure debt, but they do like to know that you have something backing up the loan, whether it be cash, investments, property, vehicles, whatever it is, collections, whatever. They like to know that you have something of value backing up the loan in case you have to sell something in the future to pay it off. Okay. Character. Character refers to your stability as a client. Okay, so that means how long you've been a client at your current bank that you're applying at, how long you've been in your current job, how long you've been at your current address, those sorts of things. The longer, the more stable a client is, the less risky a client is, and that can obviously, impact your interest rates as well. Then the 5th of the 5 C's is, of course, your credit report. They'll pull your credit report and they'll like to see how you've managed debt in the past, the types of debt you've had, your payment history, all of that sort of thing. Then they take all of that information, put it all through their computers, and they get spit out a recommendation on whether or not your application should be approved, what interest rate would apply, all that sort of thing. And again, those those things all have a risk element. So if you can manage those, so if you can build up your net worth, you're a lower risk applicant. If you have a higher income or lower debt, that's your capacity, that's lower risk. If you have more collateral, that's a lower risk. If you're more stable, not moving around a lot, that's a lower risk. If your credit report, you've got a variety of credit, you've got good payment history, those sorts of things, that lowers your risk. So those are things that you have a relative amount of control over. So with that background, what are some of the ways? This is just sort of a high level overview of the different types of ways that you can lower your interest rates by largely reducing risk, or by risk takes into account, or these take into account the amount of risk. So one way, number one, would be simply to pay your debt faster. Now, this isn't actually lowering your interest rate. This is just paying your debt faster, so you're paying interest for a shorter period. So this could in a lot of cases, obviously, this is going to mean higher payments on the debt. And as a cash flow specialist, that's one of the things that I do, is I try to I work with clients to help them free up what I call latent money in their current finances, to free up that money so that they can focus it on debt, focus it on mortgage, focus it on their other goals, savings goals and whatnot, to free up that money so they can reach their goals faster. So paying off your debt faster can reduce your overall cost of debt. If that's not possible for whatever reason, then other options are you could apply for a lower rate credit card. Every bank has a credit card that's somewhere in the neighborhood of 11 to 13%. A typical rate here in Canada for sure would be around 20%. And so if you can apply for a lower rate card that brings your interest rate down, again, that means that more of your payment will go towards principal, and that can save you some money over time. Now, you can also consolidate debt. So there's four categories or four things I'm going to talk about in terms of consolidating your debt. But that's another way to lower your interest rate and the cost of your debt, is to consolidate. So obviously, one way to do that is a consolidation loan, where the bank will lend you a chunk of money that you use to pay off different debts, and then you just pay that one loan back rather than all these separate debts, credit cards, lines of credit, whatever. So lines of credit consolidation loans typically have interest rates somewhere in the neighborhood of 8 to 15%, depends on the application. The word of warning here is that consolidation loans are often a sign that there's some sort of financial issue, some sort of financial trouble in an application that requires the debt to be consolidated. So that can have a slightly negative effect on your credit. It's not a huge thing, not something I'd worry too much about if that's an appropriate option for you. But the goal of a consolidation loan would be to have your overall or your average interest rate lowered, and hopefully to lower your monthly payments as well. The second form of consolidation would be a credit line that's secured by your property. So this is a credit line. It's a revolving form of credit. You get a certain amount of money, you can use it and then pay it back. When you pay it back, you can use it again like a credit card. So that's a similar idea. Anything that's secured, meaning that the lender has a claim on some sort of property. So in other words, a secured line of credit, let's say they might secure it to your house. That means that they have a claim on your house. If you're not able to make payments, they have title to your house up to the amount of whatever the balance is on the line of credit. So, but whenever it's secured, it automatically reduces the risk because there's an asset backing up the loan. So that automatically lowers your interest rate. On a secured line of credit, again, it could bring your interest rates down as low as close to your mortgage rate, 3-4%, up to maybe 6, 7, 8%. So, and I've seen higher as well, but it often brings it lower. Similarly, you get a home equity line of credit. So this is another form of line of credit that's secured by your house. It's a different type of mortgage product that has a mortgage component and a line of credit. The interest rates on home equity lines of credit are usually around the rate of your mortgage, so in that 3 to 4% range. So these are, it's another way to bring your interest rate down, and then you use that line of credit or that home equity line of credit to pay off your other high interest debt. The third form of consolidation is to roll your debt into a mortgage. So when your mortgage is renewing, if you've got at least 20%, or let's say your mortgage is no more than 80% of the value of your property, you could apply to have your other debt, your credit cards and whatnot, rolled into your mortgage. So it's not a separate line of credit, it's actually putting it into the mortgage. And so that could obviously bring your 20% credit card down to 3 or 4%. And then, that could now obviously you're going to pay that off over a longer period of time. So you have to kind of see if you can weigh that. But it could bring your interest rate down significantly. That could save you some money. And the fourth form of consolidating your debt would be to get an unsecured line of credit. So this is a line of credit that, again, you use and pay off and use and pay off. That's not secured by any property. Now, therefore, it's a higher risk to the bank, and therefore your interest rates are typically higher on an unsecured line of credit, and it could range anywhere from 8 to 15%. Excuse me. But if you can get a line of credit in the 8 to 10% range, and then use that line of credit to pay off your higher interest debts, again, that could save you some money over time, assuming that you're going to be putting money onto it fast enough to pay that line of credit down faster than you would, say, a credit card, or in a reasonable amount of time. Okay, so those are different forms of consolidation loans. Okay, so just to recap quickly, the different ways of reducing your interest rate that I've talked about would be to pay to reduce your cost of interest. Let's put it that way. Would be to pay your debt faster, apply for low rate credit cards, a consolidation loan, a credit line or home equity line of credit secured by your house, rolling your debt into your mortgage, an unsecured credit line, and then, like I suggested before, the 1, 2, 3, 4, 5, 6, the seventh way to reduce your cost of interest and have a lower interest rate is to maintain good credit. So when you go into a bank and apply for any sort of credit, they look at your credit, the amount of risk that you offer as a client. And if you have a good credit history, good payment history, you have some assets backing you up, you have some savings in the bank, all those sorts of things, then you become a lower risk to the bank, which lowers your interest rate. So maintaining a good credit rating can also help to lower your interest rates right from the outset. And number 8, this is relatively new. In fact, last night I was doing some research on this, and I hadn't heard of this before, but it's relatively new. It's called group lending, or peer-to-peer lending. The first group lending company started in Canada in 2014, so it's very new. It's been in the US for longer than that. But basically how this works is that basically the group lending companies connect lenders or borrowers, individuals, lenders, or they're also called investors. They're just individuals. They connect them with borrowers. So you've got an investor out there who has some extra money that they want to make some revenue on. So they're willing to lend that money to a borrower who's looking for money. So a borrower basically puts their application up on this site, the type, how much money they're looking for, why, all this sort of stuff, all their credit information and whatnot. Then borrowers peruse these different applications and decide where they want to put their money. So the lenders or the investors peruse the applications, decide where they want to put their money. If a borrower doesn't get all the money that they're looking for from one lender, then they can get it from a group of lenders. That's why it's called group lending. So maybe you're asking for $10,000, and one lender is willing to offer $2,000, and another is willing to provide $3,000, another is willing to provide $5,000. So you've got your $10,000 from 3 different investors, probably all with slightly different interest rates and terms and whatnot. But you've got the money the idea of group lending is that you have the opportunity to borrow by bypassing the financial institution and lowering your interest rate by cutting out the middleman. So that's like I said, it's relatively new. It's not something that I know a ton about, but it is something worth looking at. Now, you do need to be a qualified borrower. So don't confuse this sort of thing with payday loans or anything like that, where you might where it's based on people with lower credit scores can qualify, or where they offer interest from 20, 30, 50, 100% over a year. This is for qualified. Group lending is for qualified borrowers. One site I saw had a minimum credit score that you need of 690, which 670 is the excellent score for Equifax, so 690 is quite good. And interest rates that you can expect are usually range between 6 and 18%. And the loans are often over a 3-year period. So it's another thing to look into, another option that may be available. Okay, so those are just 8 ways that you could look at reducing your interest rates. Now, like I said, as a certified cash flow specialist, one thing I do is help. I work with clients who are wanting to restructure their finances, who are wanting to get a good grip on their spending and their overall debt structure to lower their interest rates, to bring it into a more efficient interest rate structure so that they can pay the debt off faster, free up money for other goals as well. So I'm just going to post my email address in the comments section below. And if anyone is interested in a free consultation, it takes about 15 or 20 minutes. I'm happy to speak with you whenever you like. So if you just want to email me, then we can set up a time. You can just bear with me for a moment here. Okay, oops. There we go. So my email address is in the comments section below. So again, fire me a line if you want to have a free consultation and see if a cash flow plan that could lower your interest rate, restructure your debt and your spending is something that would be useful for you and of interest to you. So I'm right here every Wednesday morning at 9 a.m. For Wealth Wednesday. The whole point of these conversations are to provide some insights and tips and hopefully some inspiration to move you forward on your financial journey, so you can have healthy finances today, enjoy your future, and move forward into the retirement that you're looking for. I have a group on Facebook called Rock Your Retirement 101. Just click on, when you go to that group, just click on the link to ask to join and I'll approve that. And then once I do, enter in or click on the notification tab that tells Facebook how you want to be notified of these live events and other postings that I'll occasionally be putting up. So I hope you have a great week. Like I always say, you don't need to see the full journey in order to move forward. Just take the next step, and the next steps will become obvious. And so just keep moving forward and have a great week. And we'll talk to you soon. Okay, bye-bye.